Welcome to the Stock Market Palantir. Today we are going to talk about
ZYXI, ZYXI Inc., a medical technology company, and a name that has been on a lot of traders' minds for, well, all the wrong reasons.
That's putting it mildly. ZYXI has seen one of the most catastrophic stock collapses we've tracked this year. We're talking about a stock that plummeted from a 52-week high of around $8.72 to now trading firmly in that sub-$1 range by late November 2025.
A near 90% wipeout. It's brutal.
It is, and it demands a really rigorous analysis. So the central question we have to tackle today is this: is this insane price action a rational reflection of a company in terminal financial distress? Or is it something else? An irrational, volatility-driven mess caused by a broken market microstructure? I'm going to argue that the price is, in fact, precisely and rationally reflecting a very high probability of insolvency. This all stems from clear, irrefutable operational failures.
And see, that's where I'm going to come at it from a different angle. We absolutely have to distinguish between the fundamental distress, which is very, very real, I'm not going to dispute that, and the actual mechanism of the price collapse. I believe the sheer velocity and scale of what we saw, especially with those mass liquidations and volume spikes, that's primarily the result of some very specific speculative market dynamics. Forces that have basically decoupled the trading price from any traditional long-term valuation. ZYXI has in effect become a specialized volatility instrument.
Okay, well, let's ground this in what I see as the unassailable truth that dictated this whole decline. The market is, I think, very efficient when it comes to assessing existential risk. It's pricing in an extremely high probability of insolvency because the company's core business model, that recurring revenue, has just fundamentally imploded. We saw the definitive evidence in the Q3 2025 financials. I mean, it was an autopsy. Total net revenue collapsed 73.3% year over year.
And it's so crucial to dig into where that collapse happened. The most damning figure, and you've pointed to it, was that 82% decline in supplies revenue.
Absolutely. 82%. Supplies revenue is the lifeblood of ZYXI. That's the recurring high-margin stream from repeat orders of electrodes, accessories. It's what makes the whole model profitable. So an 82% drop isn't just a bad quarter. It's, frankly, forensic proof that those oversupply allegations from Stat News back in 2024 were accurate. It led to massive, widespread payer scrutiny.
Right, and that 82% figure, it just validates the systemic failure. It confirms the scrutiny and, the likely payment freezes spread way beyond just TRICARE. TRICARE was historically, maybe 20 to 25% of their revenue? An 82% drop in supplies proves the entire insurance ecosystem basically lost faith in their business model.
Precisely. And this confluence of crises leads directly to the core solvency threat, which the market simply has to discount rationally. ZYXI is facing a $60 million convertible senior note that matures in 2026. For listeners who might be less familiar, a convertible note is, it's debt that can convert into equity. But whether it's debt or equity, $60 million is a massive obligation.
It's a ticking time bomb on the balance sheet.
Exactly. And against that looming debt wall, the Q3 financials showed they only had $13.3 million in cash. And critically, they were burning cash. Negative operating cash flow of $6.3 million for the quarter.
That negative cash flow figure is terrifying. It signals that the ongoing operations are just incinerating capital instead of generating it.
It's a mathematical solvency gap. You do the math. The company cannot organically generate $60 million, nor do they have the cash to pay the note when it's due, which is now less than a year away. This isn't some subjective risk. This is structural insolvency risk. And it absolutely justifies the sub-$1 valuation. The market is being entirely rational here.
Okay, I see why you're hammering that debt wall. It absolutely establishes the terminal risk. I get that. But I'm going to argue that the velocity and the specific trajectory of the price drop were dictated more by market mechanics
than just a simple balance sheet analysis. The market microstructure of ZYXI right now has all the classic hallmarks of what you'd call a terminal equity, a stock that's either in its final liquidation or is just a vehicle for extreme speculation.
Explain what you mean by market microstructure in this specific context.
Sure, I'm talking about the actual architecture of how trades are executed. We're seeing off-exchange and dark pool trading consistently making up more than 50% of the total volume. This signals heavy internalization of retail order flow. So buy orders from individual investors are often executed internally by market makers, not on a public exchange like the NYSE. And this is key because it obscures true, transparent price discovery. When a market is under this much stress, that lack of transparency just allows volatility to amplify the price decay.
But how does the trading venue explain a nearly 90% fundamental collapse? The problem started with an 82% revenue loss, not with where the trades were happening.
The operational failure was the trigger, I agree. But the microstructure was the accelerator. It amplified the collapse way beyond what fundamentals alone would dictate. Just look at the volume explosion right after that awful Q3 earnings report on November 19, 2025. 71 million shares traded in one day.
71 million?
Yeah. And you noted yourself, ZYXI only has a float of about 30 million shares. Trading twice the entire float in a single session? That is not long-term fundamental investors making careful decisions. That is a mass liquidation event, and it's being facilitated by high-frequency quantitative strategies.
I'd say that volume surge just confirms that the smart money was all running for the exit at the same time. Funds like Renaissance and DE Shaw, they might have increased their stakes, but they're not investors. They're arbitraging the volatility, harvesting tiny movements. The traditional institutions, the ones who actually care about PE ratios and solvency, were executing a synchronized exit.
But the mechanism of that exit matters. The stock isn't being traded on solvency anymore. It's being traded as a velocity instrument. And think about the short interest dynamic. The days to cover metric, which, measures how long it would take shorts to cover their positions, was incredibly low, around 0.15 days. So for the general listener, this means short sellers can get in and out with almost zero risk of a short squeeze.
Okay.
And that dynamic lets them operate with impunity. They can continuously suppress any upward price pressure, no matter what the news is. It creates a mechanical ceiling on the stock price.
You're focusing on the mechanics of the liquidation. I'm focused on the reason for it. Let's go back to the regulatory and operational collapse that started all this. The TRICARE suspension, that was the liquidity guillotine. The cash flow from that cornerstone customer just stopped. And it all stemmed from those June 2024 Stat News allegations of waste, fraud, and abuse. That created this undeniable financial crisis. The company's Q3 2025 net income loss was $42.9 million. That's a nearly 2,000% drop. That is the irrefutable failure the price is responding to.
I agree. The TRICARE suspension, which is still going on, by the way, despite their appeal, was severe. It created the initial crisis. But that fundamental failure was then seized upon and magnified by this broken market structure we're talking about. The fact that this stock is now just a vehicle for dead cat scalpers, speculators who jump in after a huge drop just to trade the tiny rebound, it shows that rational long-term price discovery has been completely abandoned. It's just algorithms harvesting fluctuations now.
But that harvesting is the effect of a broken company, not the cause of the collapse. You can overlay the most complex trading strategy you want, but the core signal is deafening. A $43 million net income loss in one quarter is just too loud to ignore. Plus, the fact that the TRICARE suspension is still in place raises the very real possibility of massive recoupment demands, payer clawbacks from them and probably other insurers who follow their lead.
The potential liability from those clawbacks that is a huge overhang.
And that risk alone justifies this price, regardless of where the trades are executed. The price is reflecting the high probability of a very costly legal and financial battle that could easily eat up any remaining cash.
That's a compelling point on the future liability. But let me challenge this idea of a definitive, terminal outcome by looking at the strategic signals from the company's leadership. If this was just a straight path to a value-destroying Chapter 7 or Chapter 11 bankruptcy, why the abrupt, very strategic change in management focus?
You're talking about the recent executive hires.
I am. The hiring of Stephen Dyson, a 25-year private equity veteran from Apex Partners, that's highly indicative. His compensation is explicitly tied to a change of control event, a COC. For the audience, that usually means a sale, a merger, or a major restructuring. This tells me the board is trying to position the asset for a strategic exit, a buyout, a sale of key business lines, not just passively accept liquidation. The market price, as low as it is, seems to be pricing in this high-risk, high-reward possibility, not a definitive zero.
I'm not convinced by that because that $60 million debt time bomb makes any strategic signaling almost irrelevant for the common shareholder. Look, the board is clearly seeking a resolution. They hired restructuring advisors, they formed a special committee, they are absolutely in crisis mode. But any restructuring has to deal with that convertible note first.
So how does that debt structure constrain their options?
Well, the most likely path, and arguably the necessary one, is a debt for equity swap. The debt holders, the people who own that $60 million note, they exchange their debt claim for a huge, if not majority stake in the company. And that kind of transaction would heavily dilute or more likely completely wipe out the existing common shareholders. So the structural reality of that debt severely limits any upside from a change of control for common equity. Management is preparing for an insolvency process that benefits creditors, not a turnaround for shareholders. The price reflects that painful truth.
I understand the dilution risk, but the market is still placing some speculative value above zero. It's not a penny stock yet. That tells me the outcome is still seen as binary, either a prepackaged bankruptcy or maybe a solvent asset sale that leaves some tiny residual value. This uncertainty, combined with the extreme selling pressure, it indicates a deeply fractured and speculation-driven consensus. It's not a clean, rational pricing of insolvency. It's a volatile fight over the scraps. And it's all being facilitated by the market structure.
Let's look at that shorting activity again, because I see it as the most rational part of this whole market. I still maintain that the low days to cover, just 0.15 days, is the critical metric. It proves the bears are in complete, dominant control. They can get in and out without any fear of a squeeze. The high short interest is rational because sophisticated investors see that the company is functionally insolvent. The price reflects that consensus.
That's one way to frame it, but I see the mechanism differently. You have to look at the off-exchange short volume ratio. It spiked to over 62% on earnings day.
62% of shorts off exchange? That's a staggering number.
It is, and I'd argue that market makers are using synthetic shorts to facilitate all those retail buy orders in dark pools. When a retail buyer comes in, the market maker internalizes the order and might use a synthetic short to hedge their own position. So they're essentially creating selling pressure at the exact same time as buying interest comes in. This actively suppresses the price, regardless of any real, organic demand from buyers. That opacity prevents transparent price discovery and creates a scenario where the price is just mechanically driven lower. It's not a rational mechanism.
But even mechanical suppression can't overcome a fundamental exodus of capital. Ultimately, whether the trade happens on a lit exchange or in a dark pool, the institutional capital flows tell the real story. And the fundamental capital has fled. Look at the filings. BlackRock cut its stake by 23%, Goldman Sachs by 47%. And who replaced them? Quants, Renaissance, D.E. Shaw, they upped their stakes. This institutional exodus confirms the fundamental verdict is terminal. The stock is simply a high-volume vehicle for quants to harvest volatility during a messy liquidation. The price of 80 or 90 cents is just the market's current best guess at the terminal recovery value for common equity, which is, likely near zero.
And that rotation just confirms my point. The stock is no longer a fundamental investment vehicle. It's a mathematical instrument for trading volatility.
I still believe that the confluence of overwhelming fundamental evidence, the TRICARE suspension, the 82% supplies revenue crash, and that looming $60 million debt wall, it all means the stock price is rationally discounting an outcome that is overwhelmingly likely to be bankruptcy or massive dilution. The market noise, the volume spikes, all the microstructure mechanics, that's just the violent, high-speed mechanism of that final liquidation.
And I'll conclude by saying that while the fundamental distress is severe and very real, the price action and the extreme volatility are primarily a function of a broken equity microstructure. It's defined by high off-exchange internalization, extreme velocity, and purely speculative positioning. To really understand ZYXI,
You have to distinguish between the company's terminal valuation and its highly speculative, volatility-driven trading behavior.
The ZYXI case really highlights the complex interplay between a catastrophic operational failure and the opaque, highly technical mechanics of our modern market microstructure, especially in these highly distressed equities.
It certainly does. It's a stark lesson in why you have to differentiate between the structural signal of insolvency and all the trading noise that's created by algorithmic volume when a company is really facing existential risk.
Thank you very much for hearing us. Let us know in the comments, what is your opinion, and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.